Welcome to another Explainer. Today, we're going to break down exactly how businesses solve the ultimate financial mystery, finding out where their hard-earned profits actually go. We are unpacking the statement of cash flows. I am so thrilled to guide you through this because if you've ever looked at a company's massive success on paper and wondered about the grim reality of their actual bank account, you are in the exact right place.
Picture this. You run a business. Sales are absolutely through the roof. You're looking at your income statement like, wow, huge profit. But then you go to check the actual bank account to pay yourself and, well, it's completely empty. No cash. None. Where did it all go? It's a terrifying scenario for any business owner, but honestly, it happens way more often than you'd think.
So here's how we're going to unravel this mystery today. We'll start with the core of cash flow, move into operating, investing, and financing activities, then classify some real transactions, and finally, wrap it all up with a final balance sheet.
All right, Section 1, the core of cash flow.
First things first, what exactly is this statement supposed to do, and why is it so wildly different from an income statement? We're going to treat this explainer like your personal financial detective toolkit. See, this document cuts right through the noise. It genuinely doesn't care about promises to pay later or projected future values. No way. It only cares about cold, hard, tangible cash moving right now. Because, a company can absolutely fake profits on an income statement, but they literally cannot fake cash. So looking at the formal definition here, we're setting some extremely strict boundaries. We're solely tracking cash receipts, our inflows coming into the business, and cash payments, our outflows leaving the business. And it only tracks these movements during a very specific time frame, like a single month or a fiscal year. If physical cash didn't change hands during that exact window, it does not belong on this statement, period.
To actually make sense of all this money moving around, the statement takes every single transaction a business makes and sorts them neatly into one of three distinct buckets: operating, investing, and financing activities. Seriously, if you can master these three buckets, you've pretty much unlocked the secret to reading any cash flow statement on the planet.
Which brings us to Section 2, Operating, the daily hustle.
Let's see how this first bucket builds the foundation of daily operations. The operating bucket is the absolute heartbeat of the business. On the inflow side, we're talking about cash from selling your goods to clients, doing a service, or maybe collecting royalties. It's the money actively rolling in from whatever it is your business was built to do. But on the flip side, you've got your everyday survival costs, right? Paying your hardworking team, settling up with suppliers, paying taxes, rent, and this is absolutely crucial, paying interest on debt. Basically, this daily hustle determines if your core business model is actually generating real cash.
Moving on to Section 3, Investing, the long game. Okay, let's zoom out from the day-to-day grind and look at non-current assets. We aren't selling normal inventory here. Inflows in this investing bucket only happen when you sell off big-ticket items, like liquidating land, offloading heavy machinery, selling stock you hold in other companies, or collecting on loans you handed out. And outflows? That's when you're the one buying those heavy, long-term investments. Sure, buying a massive new warehouse totally drains your cash in the short term, but you're building infrastructure for the future.
Next up, Section 4, Financing, Funding the Dream.
This third and final bucket is all about how the business itself is funded at its very core, the structure of capital. Financing inflows happen when owners inject their own personal cash into the mix or when the company takes out a massive loan, like issuing notes payable. You're bringing cash in from external sources. And the money going out? That is typically the owner pulling cash out for themselves or the company paying down the principal on those large notes payable. It's really the back-end plumbing of business finance.
All right, Section 5, Classifying Real Business Transactions.
Time to put on our detective hats. Looking at this standard transaction list, we can systematically classify everything. See that $82,000 payment of interest? That's a daily hustle cost. So boom, it's an operating outflow. What about an additional cash investment of $189,000 from an owner? That is textbook financing inflow. But check out the trickiest one on the board, a depreciation expense of $24,000. Notice how it's marked as non-cash? Why? Well, because depreciation is just an accounting ghost. It lowers the value of an asset on paper over time, but since no real cash actually changed hands, it completely bypasses our three buckets and is totally ignored on the statement of cash flows. Gone. Which leads us to our final stop, Section 6, the final balance sheet.
So how does all this look when we actually tally up the buckets at the very end of a reporting period? Well, check out this real statement of cash flows for ABM Online Company from June 2019. You can literally see the three sections stacked right on top of each other. First, they collected cash from clients and paid their operating expenses, ending up with a net operating cash flow of $11,200. Then, in investing, they bought a service vehicle and equipment, creating a massive investing outflow of $435,000. Yikes, right? But how do they afford that? Through financing. The owner invested capital and they borrowed money, leading to a financing inflow of $446,000. Combine those three totals and you get a net increase in cash of exactly $22,200.
Let's look at one more example. This is Teen Wolf Company at the end of 2020. You'll see those exact same transactions from our earlier classification just seamlessly organized into this formal layout. They had a net operating cash flow of $72,000, gained $79,000 from investing, and netted $68,000 from financing. Add those three together, you get a total net increase of $219,000 in cash. But remember, they didn't start at zero like our last example. They actually had a beginning cash balance of $500,000. The statement of cash flows flawlessly bridges that $500,000 beginning balance with a new $219,000 increase, landing them precisely at a super healthy $719,000 ending cash balance. The ultimate financial lie detector has spoken, and the mystery of the growing cash is totally solved.
As we wrap up this explainer, I kind of want you to think about your own wallet. We all have our own personal operating expenses, our own little investments, and our own methods of financing. If you tracked every single inflow and outflow of your personal life for a month and tossed them into these three specific buckets, what would your personal statement of cash flows actually look like? Are you generating positive operating cash flow, or are you just surviving entirely on financing? Applying this simple, methodical framework to your own life might just reveal the unfiltered truth about your personal financial health. Definitely something to think about.